Good morning. Welcome back to another Stock Market Open live stream. Today we have PPI data. That is our producer price inflation report. It is expected to come in lower than the CPI report, driving a wedge between both the CPI and PPI. PPI looking like we are hunting for a zero point 0.1 on the month over month, with food energy looking for 0.2, 0.2 on food energy trade, and then year over year we're looking for 1.3. 2.0 and 2.5. So let's see what we get. That data comes out in about 4 minutes. We do also have bank earnings coming in a little lower with regulatory charges. Part of me wonders if, and I don't know this with certainty yet, but part of me wonders if the banks sort of dare I say, colluded to purposefully take regulatory charges to make their profits look lower, to try to send a signal to the Federal Reserve: don't charge us more money. See, we could mess up your market otherwise. Who knows? That's just a miscellaneous idea that crosses my mind. But anyway, we are. It looks like the JP Morgan earnings call is taking place right now. And again, we're about 3 minutes away here from PPI data. But let's see what kind of headlines we're getting from. Well, we're going to go deeper than the headlines, but let's look at some of the data we're getting from JPM. At the same time, oil is rising because even after the strikes yesterday, which I was hoping would create some stability, we now have an oil tanker firm that just bailed and basically said, you know what, we're done. We are going to pause shipments in the region of the Red Sea. And now we're starting to see some of the Red Sea shipment impacts with, for example, Tesla getting hit. Having to shut down the Giga Berlin facility for about 2 weeks starting January 29th. So we're starting to see that supply chain gap. I suspect that Tesla gap would probably only be a one-time gap, given that it's probably just a 2-week delay from going around the coast of Africa, right? I hope that is not a delay that would recur, but we can't know with certainty. So we'll see. I'm sure we'll learn more from the actual earnings call from Tesla. But anyway, we've got JPM earnings. Let's take a peek at what we have here. So, okay. Okay, let me get the actual numbers here. Yeah, a lot of pre-talk today. Okay, here we go. Okay, so big number. Fourth quarter net income $9.3 billion, $3 per share. This includes an FDIC special assessment of $2.9 billion. Okay, that is not anything you can make up. That's part of the banking crisis. Banks were going to be responsible for paying a larger FDIC share, given that FDIC had to pay out for a lot of bailouts. Boy, but that's a big charge for JPM. That's more than the wedge deal. It seems like they got on the banks they acquired. But anyway, adjusted revenue over at JPM comes in at 39.94 versus the estimate of slightly more than that. Credit loss provision came in a little higher than expected at 2.76 versus 2.42. You've got sales and trading revenue coming in at 4.03, a little higher than actually expected versus the 384. And so looks a little bit of a mixed read here. I think that FDIC charge was pretty surprising with how large it came in. It looks like FDIC special assessment and discretionary securities losses. Yeah. So that took nearly $3 billion off. 2.7 there. JP Morgan calls these record results, both on net interest income and credit, but remaining confident in their ability to deliver healthy returns. Bloody. Fine. We'll get into a little bit more of the nuance in just a moment on JPM, but let's get the PPI numbers, because the PPI numbers are going to be out in just a moment. We are about 10 seconds away from PPI numbers. Here we go. Okay. Fingers crossed we get a nice soft report, because boy, yesterday, people did not like yesterday. Oh, it went negative. Holy crap. PPI final demand month over month, negative 0.1 as opposed to the 0.1 expected. PPI core month over month came in at 0 as opposed to 0.2. PPI X food, energy, and trade came in at 0.2. That's at expectations. Year over year comes in at 1% as opposed to 1.3. Year over year X food and energy comes in at 1.8 versus the 2.0 expected. And then X food, energy, and trade comes in at 2.5 versus the 2.5 expected. Keep in mind, Once you take trade out, you're getting that negative, right? You're getting the negative from trade. So that's a sign of exporting deflation, right? Or us basically accepting deflation from other countries. That has now become clear in the PPI numbers, which is good. So hopefully that leads to less pressure on our consumer prices, but there's definitely a wedge here. But we now officially have headline headline, sorry, deflation in the producer prices notes that release that just came out. I'm going to get into the actual detailed groupings here, and that we can see exactly what the moves here were. Share screen, producer prices. All right, here we go. Okay, perfect. Okay, let's take a look at this. But so far, I'd say initial reaction here. This is very positive. So let's see what we have. Okay, these are the producer prices. Here are the relative weights on the left, and then we're looking for that seasonally adjusted 1 month change on the right. Look at final demand goods dropped 0.4%. Nice big drop here. Let's go. I want to see services. Final demand services 0. Wow, look at that. Final demand services, it's been 0, 0, 0, 0 for the past 3 months. Final demand services have been 0. We've got trade of exports, negative 1.3 on exports. Final demand of transportation and warehousing, negative 0.4. This is all great for companies with margin. Transportation of passengers, final demand, 2.1. That's pretty high. This number has been fluctuating quite a bit, but this would be, think airlines, think ferries, whatever. So warehousing for goods, negative 1.2. Final demand, less trade, transportation, warehousing. This is final demand services. This is your more core. That's a pretty warm number, though, 0.4 right here. Final demand services, less trade, transportation, warehousing. So once we take out, some of the more disinflationary factors, we got about 0.4 left over here on final demand services. Private capital investment services, 0.7. That's interesting. A little bit of a push up here. This is a 4.2 or 4.3% weight. Final demand construction coming in at 0.1%. Yeah, that's the hottest sector here is private capital investment services. Interesting. Final demand exports. PPI is always a little less relatable to read compared to CPI, but we can still do it. Final demand foods, negative. Final demand less energy, -1. Trade services, 0. A lot of negatives here. Look, what do we have here? Final demand services, less trade services, 0.3. This really does represent some of the sticky component of inflation. You see it at PPI as well. Personal consumption comes in at 0. Personal consumption of goods comes in at negative. You've got personal consumption of goods, less energy comes in at 0.4, less foods, 0.1. I mean, these are all very, very nominal numbers. Materials and components for manufacturing comes at 0.2, nominal. Durable manufacturing comes in a little stronger. This could be your washing machines, your cars. So actually surprised that one came in at 1.3. I wonder if that has to do with some kind of larger seasonal adjustment there. Negative 4.1% on processed fuels and lubricants. It's interesting. WD-40 actually did pretty well on their earnings report, and their stock pumped. So let's see here. Okay, services. This is where I want to have a little bit more color. Services for intermediate demand, 0.4. These numbers are a little warm here for services. And I'm trying to see if I can understand what within it. Here it is. It's this 2.4 number. A lot of transportation of passengers for intermediate demand manufacturing and non-manufacturing. A lot of transportation. That's a transportation-based service. We saw that in CPI as well. Yeah, energy clearly fell. We knew that. Yeah, but almost no real signs of broad-based inflation here. I mean, most of these numbers are negative. Transportation of passengers is just consistently the one segment that is really pushing numbers up here. And then, of course, we had that capital investment sector as well. Yeah, I mean, you get into some of the actual nuance over here. You're negative 10% on one of the energy parts over here. Total goods inputs to stage two, negative 4.1%. Folks, that's on a month. On a month, negative 4%. Total food inputs, negative 2.8. For various different stages in production here. Stages in production are pretty complicated, but point of it is this is pretty deflationary. The only thing that I see here that's slightly inflationary has to do with the private capital goods services, and then what we saw with transportation of passengers, which we saw in the CPI read as well. The CPI read yesterday as well showed some strength in transportation of passengers. So this is being called by the suits right now. They're calling this a surprisingly low print on core producer prices, aligned with potentially weaker demand. It seems to be triggering a rally in bonds. Let's see what we got going on in bonds. Right now, we've got the bond market. Well, not really. I mean, the 10 years like down 1 basis point. I mean, I'm not sure if you can really call that a rally, but okay. The 2-year yield fell to 4.22, lowest since May. July, August SOFR yields are 4 basis points lower. That's the standard overnight funding rate, by the way. When you hear SOFR, it basically replaced LIBOR. If you've ever been into like commercial financing, you might have heard like banks charging you LIBOR plus 1% or whatever, 115 basis points, whatever. Okay, so yeah, this is actually a very incredible report. It just shows you that there are some nominal areas left with producer price pressures, and that's really starting to relax. Which again, good. That's exactly what we want. So really happy to see that, and helps sort of offset that strength we got on that core CPI read yesterday. What was interesting is the Chicago one of those Federal Reserve banks puts together the inflation nowcast, and the nowcast, which is often just like so variable, was actually right on this time, which is quite interesting. So yeah, I think the nowcast was forecasting 0.31, and we got 0.31 versus 0.25 expected. So yeah, okay. So then let's see what else we have here in terms of some of the updates. Okay, let's go jump into, well, quickly, we're going to look at how the sticks are performing in reaction to this. After the sticks, I want to keep going through the JP Morgan updates just to see what we have. Maybe we can take a peek as well at BTC. Somebody here is face palming because they say Tesla is so weak. You know what's so interesting is I think a lot of people are going to start paper handing Tesla if they haven't already yet. And it's really unfortunate just because it's probably going to go down as one of the most difficult times for the company. Highest interest rates ever, combined with supply chain shortages and ramping. Oof, tough time. Anyway, so what do we have here? Okay, this is the Nasdaq. The Nasdaq turns positive here after the substantially weaker PPI readings. So you could see not much though, frankly. I mean, barely positive, 4 basis points. Let's see what's actually moving. So if I look at the pre-market here, Open Door, MP Material, Enphase, SoFi, I mean, all your classic suspects of interest rate sensitive stocks, with the exception, of course, of Tesla, now dropping below 220. Now, we did expect this would happen, 222. Remember that we made this pretty clear. I also posted this on eHack. I said, I'm very bearish that we're in the middle of this range. And I thought we were going to complete the Fibonacci retracement down to 221. It looks like today is going to be the day we do that. I think you're not actually going to see a breakout on Tesla until you have earnings that are. What you really need is management optimism in earnings. That's much more enthusiastic than what we've been used to in the last year. So I don't. Jeez, Lord. I'm somewhere like on the I don't know, 20th floor or whatever in Dallas, Texas, and I feel like there's a tornado outside every day, well, every minute. But anyway, so what do we really need over here? I mean, well, we'll look at this convergence that you'll end up getting over here on again that 258 number. You really need earnings that are going to push you up and break you through the trend. And it's not just this near-term trend, but we have a long-term trend on Tesla as well. This is a very near-term trend. I just went with the day chart, but you can even go out on the week chart. I'll delete that one. I have it on my other computer, but you go out on the week chart. I mean, you could draw the same downtrend on Tesla. And for a company that's innovating this much in the AI space, it's remarkable how much this company is punished by very short-termism. And that's okay. See, this is the line based off the week chart. And so again, it's really going to give us another opportunity to test that 258. It looks like right around maybe February 5th, beginning of February, we'll really be at another one of those intersections where you're going to want to hope for a breakthrough over here on Tesla. But anyway, so this gives you a little bit of a breakdown on again what we have with um, PPI, what's going on with Tesla, Coinbase down another 1.51%, Palantir down 54 basis points, Bitcoin sliding after the approval of the Bitcoin ETFs. I mean, this was somewhat expected. We were expecting some element of buy the rumor, sell the news. So, a lot of people were trading into crypto for the approval of the ETFs. And I think what you're going to get is you're going to get some reallocation to some stocks that have really started selling off. I mean, look, for example, to me, it's very difficult right now to justify buying the NASDAQ. Look at where you're sitting on the NASDAQ. I mean, just zoom out on the week chart for a moment. You're at all-time highs on the NASDAQ. To me, it's very difficult to justify buying the NASDAQ or a company that, in my opinion, is like incrementally better because of AI. And it's blown past these previous highs, and that's Microsoft. I don't know, maybe they'll figure out how to be substantially better with AI, but whatever. I think you can make a justification for Nvidia. I don't think you can make a justification for some of these other companies, but these are very expensive. And so when you look at opportunities and you look at what's going to perform well in 2024, personally, I think, well, I mean, you're going into an interest rate cutting cycle, so it would totally make sense to consider some of those that have really been beat up that are interest rate sensitive. So that could even the way SoFi has been trading is very interesting. I don't have exposure to SoFi, but it makes me wonder every time it seems like we get dovish news on rates. It's Open Door, and Redfin. They're always here. And SoFi, Open Door, Redfin, SoFi as trades on soft news. They see that trade seems to work out every single time. Obviously, no guarantees, but I find it very interesting. Okay, so now let's jump into. I want to get a little bit more data on JPM. Of course. Of course, JPM ends up going positive after their earnings, after first dumping on their earnings. So let me see what else we have from JPM. Oh, wait, hold on. In contrast to CPI, producer prices edged lower than expected, providing some support for the Fed narrative. Moreover, prior data was revised a little lower. Let me look at that. Yes, that's true. Oh, yeah. Okay, they just came out with the revisions. The prior data was 0 on the month-over-month. That was revised down to negative 0.1 as well. So that's 2 months in a row of negative 0.1 on the month-over-month reads. The PPI final demand year-over-year was revised down from 0.9 to 0.8, and ex-food energy trade was revised down from 2.5 to 2.4. Okay, looking a little bit more at the JPM numbers here. Obviously, the big FDIC charges. Okay, so trying to get some information. Okay, here we go. Diamond's commentary. He calls that 514 billion of loss absorbing capacity staggering, boasting of their fortress balance sheet. Again, calling that Basel III regulation could cause serious harm to the banking industry. This is what you're going to expect every single one of the banks to talk about. Jamie Dimon warns that quantitative tightening is draining over $900 billion of liquidity from the system annually, and we've never seen a full cycle of tightening. And with wars going on in Ukraine and the Middle East, with the potential to disrupt energy and food markets, migration, and other relationships. There is a dreadful human cost, and the bank remains cautious. Well, yeah. This is such a bizarre time. Okay. Taking a peek here, assets under management were up 3.4 trillion. This makes sense. After the banking crisis, people come flooding into big banks like JPM. Frankly, they're way too big to fail. Uh, First Republic. Let's see here. Net income was 9.3 billion, down 15%. Okay, so they have a little breakout for First Republic. That's fine. Okay. Looking just for a little bit more on JPM. They're just calling it overall another solid quarter from JPM. Residual inflationary pressure is being warned of. That's fair. That could also have to do with just what consumers have to deal with, right? Let's see here. CFO says he doesn't see consumer weakness with most relative metrics normalizing. See, that's also fascinating that there's a normalization in the consumer rather uh, than any kind of additional red flags from JP Morgan. I actually think JP Morgan is and the banks are fantastic at evaluating this because unlike the credit card companies, they also know what people's bank balances are, their exposure to equities, often their financing with real estate or the credit situation or whatever. So let's see here. Bitcoin, the firm itself says they have no major exposure to Bitcoin. Jamie Dimon, remember in the past, has been very anti-Bitcoin and suggested that if he were the government, he would shut down Bitcoin. Threat of capital rules, threat of litigation costs because of capital rules. That's the boring part of the bank earnings. I always honestly get a little bored when they complain about regulation, but that's all they ever do is complain about regulation, which I understand. That's what they think. Okay, interesting. So Larry Fink is wrong. Rate cuts timing. Fed thinks the Fed will begin cutting in June. Yeah, you know, I think a lot is really just the Fed's just going to punt in January here, and they're going to let the next two CPI reports tell you. So, this could have been a hot one in January, and it wasn't even that bad. There were very, very specific sectors. Like the used cars bump was crazy. That came out of nowhere. Yeah, and it's not even measured in the Manheim. So it's sort of like, how did you guys rig that used car sales went up? But okay. But as far as rate cut expectations, I'm shocked the markets are still this confident in March. You're sitting at 71% chance right now. 71% chance of rate cuts. So I don't know. To me, I'm still blown away by that. Yeah, not sure why they do that, but okay. So used cars are collapsing. Well, that's what I thought. So the fact that we are seeing used cars come in with positive CPI, blows my mind. Squeaky wheel gets three greasy eyes. Well, that's exactly what the banks are doing right now. They're being very squeaky. Crypto is the monetization of how data moves in a network. Yeah, you should see my interview with ARK Invest. So when you're done watching this, watch the ARK Invest interview on the main channel. Just posted. It's incredible on Bitcoin, AI, Tesla, Trump versus the Fed. That was fascinating. Trump versus the Fed. So yeah, stay tuned for that. That was really interesting. Okay. By the way, I wanted to just thank everybody who's sending. Some of you were emailing, whatever. But thank you for those of you who are asking for more lectures in the Gold course. We'll have some more of those filmed next week as we get into our coupon expiration at the end of the month. So pretty excited about that. So email us if you want to bundle up, staff@mekevin.com. And of course, join us in the course member live streams every day. Okay, so let's keep moving here. So this is the information we have on JP Morgan. Let's see what else we have. Oh, there's Bill Ackman. Oh, is he? Let's. Yeah, Bill Ackman's on Squawk Box. Okay, here I can pop this out. We can see what he's complaining about. If he's just complaining, yeah.
To give money to something affiliated to that donor. So that's problem number one.
I mean, I hate to say it, but it's a lot of complaining about his personal problems. I don't know if this is really going to help the markets, or do we really care about this?
To give money to MIT for affiliated things, and then also occasionally other things. This, a Fidelity donor advised fund, you can never do this. And the benefit to him is his wife, even though MIT DAF is the only funder of his wife's charity, they could, this could not, he couldn't give money directly and get the same tax deduction. That's the problem. So I attacked the chairman of MIT. I thought it was fair game, okay, in light of what's going on. And he's putting at risk the tax exempt status of the donor advised fund.
Larger question, though, about your role as both a donor and influential.
Yeah. Honestly, this is not worth watching. Bill Ackman's drama on these colleges, I personally have found it very uninteresting. Um, so yeah, I don't know. Maybe you find it interesting, but I don't. Sorry. But let me know. Maybe I'm wrong. I'm just tired of. It's like every day there's new drama with this Bill Ackman guy. Like God. Okay. So I thought it was supposed to be YouTubers that were dramatic. Okay. I want to see a little bit of movement here on gold. This is IAU. Look at this uptrend on gold, by the way. I was looking at this yesterday a little bit, and this uptrend has been going on since COVID. It's really just like the geopolitical strife that we've been, gosh, dealing with just nonstop. Just nonstop uncertainty in markets today. So I thought that was very interesting. At the same time as, of course, you've got some pain over here at Bitcoin, but I think that's probably going to be relatively short lived. Well, keep in mind the Bitcoin enthusiasm that ARK Invest, for example, has. I mean, their bear case is a 12x for Bitcoin. And so if you want to see what's going on with their estimates, make sure to watch my interview over there on the main channel. But anyway, somebody here writes, rates moved down on CPI and now they moved up on PPI. What's the explanation? I don't really remember rates moving down much yesterday. I mean, it ended pretty stable. I think if you're just looking at like CNBC or whatever, and you're just sort of looking if it's green or red, stuff fluctuates so much. There's a lot that goes into it, but 10 years been pretty stable, really around 4%, which is certainly higher than the 3.8 that we've seen. And I think we'll be setting up for another leg down probably within the next 3 to 4 months. Give it 3 to 4 months, maybe even as short as 2 months. You'll see another leg down in Treasury bond yields. That means TMF will have another rally shot. You'll have another rally shot at growth stocks. Remember, folks, I think people forget this. People are like, "Oh, Kevin, Nike swoosh, man, it's so red." Sometimes I think everybody forgets what I said before the Nike swoosh part. It's not like I mean, like this should be very clear to you. I've said volatile Nike swoosh, not because I think that's like a convenient hedge, but quite frankly because like everything's kind of like a little bit of a shit show, like geopolitically, local politics, like U.S. politics. U.S. politics are a disaster. We can't have like we there. I mean, like I don't know. Sometimes I just wish there could be just like super normal options that have just great heart for the country and no drama. But we can't have that. We have lots of drama on both sides. And then we've got Ukraine, Russia, the potential for Taiwan, China, Israel, Gaza, the Red Sea. I mean, boy, the amount of tumult. Javier Milei talking about taking a chainsaw to his central bank and ending the central bank soon. The we can't pass a budget for the life of us. Now we're thinking about kicking the can down the road again on passing a budget, which just blows my mind. Remember the last time they kicked down a can down the road in a two-part method, they kicked it down to January and February. Now, uh, yeah, Punchbowl News is reporting how the House has turned government funding into a mess. 1 week until shutdown. What's going on? Yeah, okay. Mike Johnson cut a deal with Senate Majority Chuck Schumer to fund spending for fiscal 2024, basically at the Fiscal Responsibility Act levels. There were $16 billion in additional cuts. Johnson sent out a letter Sunday saying he had secured hard-fought concessions. He took the House Republican Conference to sell the deal, or took to the. Johnson went on Fox News to say Republicans have been responsible and govern, but by Thursday, Johnson was holed up in his office with hardline Republicans who were imploring the speaker to abandon the spending deal. My lord. In fairness, just like the extremism we're seeing in politics is getting worse and worse and worse. And that's not to say there shouldn't be some, but it is creating relative dysfunction. Okay, so anyway, so here's J.P. Morgan, again up about 1.8% on these bank earnings. Looking at deposits, let's see here. Okay, we're at the Q&A section right now of the JPM earnings call, so we'll see what loosens up here. But now there's talk about oil's geopolitical risk premium getting stickier. Remember, we were almost at $70. I think we actually, for a brief moment, went down to $69 per barrel, and now we're back over 80. Mostly, I mean, this Red Sea stuff is horrible. Well, consider this: you just had an oil tanker firm actually say, you know what, we're done as well. What? And I'm like, wait a minute, the oil tankers weren't being targeted by Houthis. Not only were they not being targeted, but I thought, well, I was at least hopeful that the strikes yesterday would have led to more stability in the region. Now you've got, a tanker firm, Stena Bulk, halting southbound, which is weird. No, well, I guess southern Red Sea transit, so they can, enter the top and still float around over there. But they don't want to pass through the southern portion of the Red Sea, which is down the lower part over there by Yemen. And you've got basically an oil firm that before the strikes was shipping, and now after the strikes, which should have given some more faith in the region, saying no thanks. Keep in mind the U.S. with the Royal Navy are patrolling the area. It's not like they just dropped their bombs and now they're leaving. They're staying in the area. Also, remember that we talked about Tesla halting production at Giga Berlin. That's going to affect vehicle production, probably around 14,000 vehicles. It's not great. 14. And these are Model Ys. So, at even a 15% margin on 14,000 vehicles, you're talking about $100 million, $105 million of potential lost net income at Tesla. But it's not just Tesla, it's also Volvo. Volvo is halting their Belgian plant for 3 days amid some of this supply chain drama. Yeah. There's just no shortage of this news. It's I was hoping we could. I mean, this is naively hopeful, but I was somewhat hopeful we can go into 2024 and things could be normal. But why would the year change anything? It wouldn't. Now, you should also expect some concern in the near term. Like I would say the next few days. Really, I mean, we've been talking about this. You're not going to expect things to get better until after earnings. Like there are too many negative catalysts. And we knew this going into this, into this year. Okay. We're like, look, earnings are going to possibly suck because you're going to combine geopolitics with inflation reports and earnings. But what's very interesting is Houthi leaders, and this is where we get to the escalation side. Houthi leaders are now saying that a response to the U.S. airstrikes is imminent. Houthi leaders are warning that the US and UK should take warnings and speech of their leader seriously. Of course, a lot of folks think any kind of Houthi counterattack will just be a joke, and they're basically just going to get wiped out. And then if they attack us, we'll just bomb the crap out of them again. But we kind of expect the Houthis to attack us. The problem now is, how bad is the counterattack going to be? And is it possible that we actually end up really lighting the fire in the Middle East, which is already a tinderbox? Who knows? But yeah, oops. Okay, so wow, Bill Ackman's going as far as now proposing a think tank just to go around and probe higher education. Well, honestly, it's probably a good thing if they did create something like that. Mostly because any entity that's unwatched tends to do little sussy things. Anyway, Citigroup says it will eliminate 20,000 roles to save about $2.5 billion as they're trying to boost returns. This is another issue: is if we go into a cycle of joblessness, the soft landing is dead. So yeah, it's going to be really fascinating. We know we've talked about this. I've called, especially on ehack.com, where you can see my research posted. So you can go to ehack.com, right? We go to ehack.com and you look and you see, wait a minute. I projected that 2024 will be the year of profit, not good profit. I'm just saying the focus will be profit. And so with the focus of profit, companies are going to be more likely to lay off to try to increase profit. Okay, well, this is a problem. Why is it a problem? Well, it's a problem because what happens when you focus on increasing profit and you need to start laying off workers? Well, that could become a self-fulfilling cycle. Whereas you lay off workers, other companies around those workers have to lay off. And if those workers can't find new jobs, the JOLT survey is going to roll over fast. Not only is the JOLT survey going to roll over fast, which I know is a little redundant because it's the job market and labor turnover survey, so it's kind of like survey. But anyway, JOLTS will roll over fast, and the Fed will probably rapidly cut. Now, I do recommend that you watch towards the end of the ARK Invest interview that I posted on the main channel. You know, I thought this was really interesting. Brett Whitten is convinced that the Federal Reserve is likely to cut more than markets expect to support a Biden presidency. And that might be done so under the guise of dollar or economic stability rather than for political purposes. But there is a concern that, what if the Fed thinks Trump would destabilize the dollar and the economy? And how could you prop up markets before the election? Well, just cut rates further. This was very interesting. Talk about the possibility of stagflation. Yeah, right. So in order to really have stagflation, so I think we have the first part. I think we have the stag, right? I do think we have the stag, but I don't think we have the inflation part. I know we have residual inflation, medical care services, insurances. The used cars bump we saw was stupid. We have residual housing inflation. A lot of that is all flattening out and petering out. And we have straight up deflation in goods. So I'm personally not terribly worried about the inflation part. And look, I'll be the first to U-turn, you know that. But it is on a daily basis that we are studying inflation, and when we're just not seeing uh, inflation. And I ask on a daily basis, I go, please send me stuff that's inflationary. And nobody ever does. So I do think you could make the argument that insurances are still really inflationary, but I don't think that's a very hard argument to make because insurances lag. You kind of have to think like prices go up, and then it takes like a year to 2 years to actually get everybody to have higher insurance rates. So how can I demonstrate this a little more simply because I don't think it's as intuitive here. Um, it's not just the lag that you really want to understand. So let me try to share the screen here. All right, let's draw. We're gonna doodle here. Okay. Okay. All right. No, I don't want to play your game. I just want to draw. Please. Okay, I'll go to a different draw. Here, sketch.io. Great. Oh my gosh, there's a spaceship. Please just let me draw. Okay. All right. So the point here is prices don't do that, right? So that's not what prices do. Prices, unfortunately, do that, right? And then it takes quite a while for you to sort of get those prices to roll off. Okay, great. So how do insurance premiums work? Well, remember, the insurances, they're not going to see peak insurance pricing or costs, year over year. Let's say that's 1 year later. They're not going to see peak prices here. They would see peak costs here, right? Which then that means it takes them another year to raise prices. And that's the scary part, is that really when they actually start realizing the cost increases, see if I can get a different color here. Oh yeah. Okay. So they start realizing the costs later, right? So you really only start getting the prices going up over here. But then it also takes a full year to roll people over to new insurance costs. So really, when it comes to inflation could be gone, and insurance costs and medical costs could still be showing this substantial uptick in inflation because there's such a massive lag in insurance. So keep that in mind. That's very, very, very important. And insurance is becoming much more expensive. Very surprised about the used car data here. Used cars have been going down in price for months. People are not buying cars right now. Yeah, well, exactly. So, I mean, the interest rates are absolutely insane, especially on used cars. So, um, yeah. Oh, Kevin, you ignore most bear folks or reports. I don't think that's true. I actually think I go out of my way to report bearish articles, and then I reply. I obviously I respond with my perspective, but that doesn't mean poo-pooing the bear opinions. I provide the bear opinions regularly, so I think you're wrong. So the biggest bear case, like T.S. Lombard, for example, put together was the idea that the Red Sea strife will end up causing more inflation than we're seeing. Yeah. Mm, so let's see what else happened here. Hertz model could work if they had bought Teslas now instead of when they peaked at value. Yeah, so I actually, Brett Whitten in the ARK Invest interview that I did yesterday, which is posted on the main channel, he actually addressed this and he had a very good argument, I thought. He argued that, Hertz bought these cars at peak value and that they have to kind of like show their shareholders why their assets took a large write down. And by selling some of it, they're able to maybe make a wrong okay because they can kind of chalk it off as like a mistake to their shareholders. So I thought that was a very interesting perspective. That Brett interview was fantastic, so make sure to watch that. So let's see what else here. Okay. Saying volatile Nike swoosh is like saying the market will go up eventually over years. So it's going on a safe. No, I disagree with you because a Nike swoosh implies that you're not making a new low. You have to remember when I started talking about the Nike swoosh, many stocks at the end of 2022 were at their all-time lows over the past 5 years. So it was a very unpopular time to suggest that the market could go up and that the market would have a floor underneath it. I actually think the market has a floor underneath it. That the reason you have a volatile Nike swoosh is because you're supported by so much cash that's on the sidelines that as stocks fall, eventually they get bought. And I'm not saying immediately. I'm not here to say, for example, Tesla gets rejected at 258 and people need to buy it right away. No, 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 not at all. In fact, it's entirely possible to get rejected at 258 and you could go all the way down to 175. My point is, I find it very unlikely that you would go back to 150, down here, the 152 range or the 101 range, because people will take the cash they have on the sidelines and just use that to invest in stocks at lower valuations. Ooh, look at this longer term potential floor trend we're actually getting here. I just saw that one. I could align that possibly with a convergence. Yeah, look at this convergence almost we're creating. This is a little sloppy, but you're coming to a head here where Tesla's probably going to get squeezed in this range here, where it's going to have a breakout. Enphase had that. I know Enphase has come down again back on a fib retracement here, and I don't have it on this computer. It's unfortunate. But as you can see, Enphase broke its massive downtrend. If I do we can honestly just quickly week chart it. I mean, Enphase was such an easy one to do this with because you could really just, draw a straight line essentially down. So it's unfortunate, but that happens in an interest rate tightening environment. Come on, Weeble. Oh my gosh, you gotta be kidding me. Anyway, you get the idea, okay? You draw a convergence, draw a trend line down, see the convergence. Wow, we break out. We were traced to the fib. Okay, now we're at the fib, 113. We should be up from here. No guarantees. That's just simple TA. Okay, so let's see what other news there is. Nike swoosh makes the market more resilient and vets out all the weak companies and therefore tends to go further than the previous all-time high. I don't know what the second part of what you mean. It tends to go further. Yeah, I mean, right. The weak companies won't go to all-time high, but the strong companies will. Yes. I agree with you. But yeah, the Nike swoosh is supported by liquidity. I feel bad for the people who don't have the means to get into the market. Without compound interest, you can't get ahead when you're taxed at 30 cents on every dollar. Yeah, well, I mean, you can get ahead with real estate. It's probably the fastest head start you could really get. No, the banks didn't actually reported pretty well. It's just they took very, very large write-downs. My dad needs a whole engine swap. He's going to scrap it for less than $400. Instead, somebody at the Home Depot parking lot offered to buy it for $1,000. Sorry if he popped used car numbers. Oh, well, good for your dad. Let's see. I know someone in Google management, and they told me last year they were thinking of laying off more just because Meta was doing it. Well, it's not only because Meta was doing it, unless management, like lower level management, is like, oh, Meta's doing it, it's going to come to us too. It's just because you can do more with sometimes removing the excess hiring that has occurred, right? If you've hired too much, sometimes you actually just create more of a distraction, and your productivity actually net goes down. So keep that in mind. Okay, we're about 16 minutes from the market open. We've got the 10-year yield unchanged right now. I'll look to see if we've got any Nick T tweets here. Cool PPI print. Yield curve. No, it doesn't. Why does Zero Hedge have an article that says the yield curve disinverts? I don't think that's true. Oh, on the 2s, 30s. Got it. That's what they're calculating. Okay, let me see if I can show that. Well, let me look at the 210 first really quick. 210 yield curve. Well, it should be a spread. I mean, we were at like 4.22 minus. We should only be about 24 basis points inverted right now on the 210. Ooh, I was close. Remember, folks, this is always painful when you have. Well, I mean, it seems that way. It seems always. I hate QuantumScape. I don't know if they're going up or down. I have no idea what's going on with them. But Yeah. So let's go ahead and pull this up. So let me share the screen here. Da, 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 da. There we go. So this is the inverted yield curve. And oh, I wish it would zoom in a little bit more. That's a little disappointing. Doesn't do that. Yeah, whatever. Okay. So, oh, by the way, see this beautiful banner we have? It's just a reminder that we have new lecture shopping for the gold level course, which is very, very exciting. So stay tuned for that. That's coming this month. And there'll be another large coupon expiration towards the end of the month. Email us at staff@mekevin.com if you want to bundle. Okay, so the last time we had a substantial steepening here, I want you to think about this. Okay, hold on, watch this. What happened between this area and this area right here? What happened between this red arrow? And I'll change the color of this one. Okay, so what happened between this red arrow is a very long sort of 3-month stock market sell-off, right? So the steepening of the yield curve is heavily associated with, unfortunately, stock market pain. So if you're wondering, like, oh my gosh, why are my stocks doing bad? Whatever. Maybe your stocks are doing good or whatever. But the point is, if you're wondering why some stocks are doing poorly, it's usually this sort of steepening is painful for stocks generally. And so it was painful here. And we're seeing that pain here at the beginning of the year as well, because again, if I just grab a new little red arrow here and I just sort of align that with this year so far, here's this year so far. So it's basically straight up. Yeah. Okay. So that shows you our 21 basis point inversion. The 2's 30 is apparently uninverted. That's fine. Okay, so that's the 2's. Let's look at the 5-year break even. Let's see if that's de-anchoring at all or if that's relatively stable. I expect it to be somewhat stable. I love how people really seem to care about my political opinions in the chat. I personally don't really like. Some people are like, oh, I'm convinced he's this or this. I'm like, whatever, man. I just want what's great for America and humanity. So anyway, 5-year break evens on the 1-year chart sitting at about 2.22 right now. If we zoom into that, we are lower than where we were in October. So share screen. There you go. This shows you the latest move here. After CPI, we got a little bit of an uptick here. Yeah, okay. That's our 5-year break even. That's really not a big deal. Are you on a business trip or a family trip? I'm actually out here to meet George Gammon and Ken McElroy. We have a lot of interviews coming out. If you haven't heard yet, we have the ARK Invest interview on the main channel already. Then I'm going to be posting a video with Matt Wallace, the Silicon Valley Owners Club for Tesla, Lauren Southern. I have Dave Packman coming up, just because I know a few of these are going to be a little bit more leaning to the right. So I'm trying to line up an equal amount of left-leaning folks as well. So I'm really trying to get both sides. And so we're scheduling that. But yeah, it's probably going to be a little conservative tilting at the beginning. Just based on timing of guests. But, whatever. People are going to criticize me no matter what I do. So, Delphi thinks I'm going to miss an opportunity on QuantumScape with their scam battery. I'm sorry. I mean their solid state battery. Sorry, I misread that. Yeah. So, I will say they IPO'd at a great time. Yeah, it's okay. I guess this is a stock chart for some folks. This is the month chart, mind you. So, oops. All right, let's go to, I want to see BTC USD here. Okay. So 45.7, actually somewhat stable over here in this mid-range. Let's see. Yeah, trying to stabilize around that upper 45s. Okay. Let's see here. Finance is conservative in nature, says someone in the chat. Well, I think that it's probably because companies seek less regulation, which just by virtue of being a company and seeking less regulation makes you more um, potentially conservative, right? Okay, so where were we? Okay, well, let's find out what else we have here. I want to see if Nick T tweeted anything. Nick T. Oh, Nick T. He did not. Oh, he's sleeping in today. How unfortunate. Still weak data coming out for China. So that's not a surprise. Larry Fink of BlackRock suggesting that Bitcoin is no different than gold and other assets that protect you, seen as a hedge. That's interesting. By the way, keep in mind, I have a very challenged viewpoint of arguing that the benefit to Bitcoin via the Bitcoin ETFs will be as clear as the gold ETFs, because the gold ETFs really took off after the Great Recession and then flatlined. Well, I don't know that Bitcoin is going to perform highly well in a recession because I see it as more of a risk asset. And I also, wonder what the gold ETFs would have done had there not been a Great Recession. So, okay, that just gives me some skepticism on comparing. When I hear people compare the gold ETF to the Bitcoin ETF, I get a little sus. Okay. Next. Okay, here's a bear argument. Somebody's trying to make this argument. Let's read this bear argument together before the market open. I want to give the bears some credence. So I found a random alleged PhD here who is going to give us a bear argument. Who knows? We don't actually know if the person is a PhD. Let's assume they are. They say they are, so they must be. Anyway, dear CPI thread. Okay, inflation rips the steak out of its chest, loses a blood-chilling scream, and tells the Fed it's ready for another round. What a bizarre headline. Like, tell me how your bias really leans. Like, there's reporting something, and then there's screaming bias before you even get into the data. But okay, that's fine. So what do we have here? First up, the headlines. Okay, well, we should be focusing on core. Yeah, there we go. We'll focus on core. For all the disinflation, no one seems to be paying attention to the trend that's clearly showing us approaching 3% and not 2%. Okay, so what this person is doing is they are taking the month-over-month figures and then they are annualizing those. Now, that's a relatively dangerous thing to do, and it's something that even the Federal Reserve doesn't do. I'll show you why the Federal Reserve doesn't do that. And again, I'm not here to just defend my position or whatever. I'm just here to try to provide perspective. So let's see here. Let's go ahead and show Nick T's response, right? Because Nick T provides a great response here, because this is generally what you do when you take CPI numbers. You multiply the 3, the 6, and the 12-month changes. You don't multiply the 1-month changes by 12 because the 1-month changes are extremely volatile. Whereas the 3, 6, and 12-month changes provide what we call normalization. So if we look at the 3-month annual change, we do see a little bit of a tick up here, even on the 3-month annualized change. But again, look at the trend. I don't even have to draw it for you. Look how volatile the 3 month is. Imagine how volatile the 1 month would be. It would just be a much more extreme version of this chart. I mean, you could see how much less volatile it becomes when you get to the darker blue lines because you're spreading the changes out over more time. So the trend, even on the much more volatile 3 month, is substantially down. So arguing that on based on simply a 1 month change that inflation is exploding like this. I think this is a very cute manipulation of the chart, where basically what they've done is they've zoomed in very heavily into something like this corner right here, right? It's almost like they're giving you this corner of a snapshot and then not showing you the long run trend. I think that's a little disingenuous. But okay, fine. Have to briefly mention health insurance. Okay, well, I mean, I wasn't even expecting to have to debate health insurance again, but remember what we said about insurances. Literally in this video, we drew out how delayed insurance changes are. Very, very important. Flawed mythology. Well, insurances are going up anyway. So now they're arguing that that's really interesting. I made the argument that insurances go up because they lag, and this person's arguing, well, the BLS's methodology is flawed, and some of it is showing down. Okay, all right. Well, that's I just I don't think it's very convincing when you go to the BLS and you say some of it's flawed and some of it's not. Look, it's either all rigged or it's not. And so I don't really even care if it's rigged or not. I think it's all equally wrong. That's my point of view. Like, I don't think it's purposefully rigged. I don't think it's purposefully not rigged. I think it's just equally, mostly wrong. But it is what the Federal Reserve uses to determine policy. So tell me the rules of the game, and that's what we're going to play with. Anyway, what else is driving the increase? Continues to be necessities like food, energy, housing, transportation. Well, I think it's interesting how they're taking headline items here like food and energy, which those are very nice things to say, but energy costs are substantially down. Housing we know is lagging inflation. Yeah, transportation did come in hot. I agree with that. That 1 month change on transportation was hot. I agree with that. But otherwise we're just throwing in like a pot here of everything. I mean, okay, thank you. Yeah, you're showing month over month. What is this? Price increase. Oh, you're showing price increases since January 2021. Bro, you can't do this. You can't take month over month inflation data and say, look, the rate is going up. As a matter of fact, let's go back 3 years and show you how oil is oil is 60% more expensive than it was. But these are extremely volatile markets. And then what you're doing now is you're going back to 2021. Food also back to 2021, all the way back to 2021, all the way back to 2021. And you got to be kidding me, dude. Um, this is embarrassing. Year-over-year change in real weekly earnings. Yeah, so real weekly earnings, so inflation adjusted, have finally started going positive again. Great, that's a good thing. That's good. Add to that higher borrowing costs. You know what this is? This is just like so far. It's and we got to get to the opening bell and we'll go back at it. But this is what bothers me is I find some of these arguments relatively weak, mostly because what you generally have to do is you have to manipulate a bear argument to get a really good bear argument together. I think the best bear argument, frankly, is the yield curve is inverted, history is not on our side, and frankly, we're probably going to see more geopolitical uncertainty, which could cause problems for inflation. Like, I think that's a very reasonable bear argument because it is true. We have a lot of unknowns. Not only is it true, we have a lot of unknowns. I'm gonna get the bell here, but it's not trying to manipulate the data by going, oh look, uh, you know, month over month when we zoom in a lot, it's ticking up, and then you go back to 2021, everything's more expensive. No shit. Oh, zero sound? Sorry. Okay. Well, sorry. I guess you missed the bell. I guess you just got the, video of that. I don't know. That's very odd why I didn't share the audio with that. My bad. But anyway, that looks very, very green. So we'll see how the market's responding in just a moment. But Frank here asks a very good question. He says, everyone says real estate is lagging inflation, but they say prices will go up. Which is it? So this is this is not. This takes some nuance to answer. I'm going to try to explain this quickly because I really want to look at the sticks. And then I want to go back to the person's bear argument. So there's a difference between real estate prices and rents. CPI inflation tracks rents, which would be which lag by about a year. So owners equivalent rents are expected to take probably another 6 months here to really roll off, and that lag could be occurring at the same time as maybe there could be a spring bump in prices. Now, I want to be very clear about that. I don't actually think there will be a large spring bump in prices. I think as rates slowly come down, inventory and supply will just go up to offset. So I think you're going to have a relatively flat real estate market for the next couple of years, which personally I'm very excited about. Um, Is it possible to get information to eHack faster? Well, the only way I could do that is if I had basically more people sitting here writing it, because when I'm live, I'm not putting it on eHack. I mean, I guess I could be. I could be like dropping things on eHack as I'm talking about them here. Maybe I could do that. But the whole thing about eHack is it's not supposed to be the fastest source, in my opinion. It's just supposed to be really good perspective. Uh, that's my take. So, but yeah, the last few days with all those traveling I've been doing has been a little tough. So I got to figure it out how I can balance that out a little bit. But anyway, I'll do my best. I'll keep trying. I really like eHack, so I'm not going to stop trying. I just have to figure out the balance. So Tesla up about, or sorry, it's down 2.3% here, but it is green candle sticking along with Enphase green candle sticking here. We've got Costco up another 61 basis points. How's Bitcoin doing at our open here? Bitcoin is down again a little bit more. We've got Coinbase. Coinbase down another 3%. Then you have JP Morgan's up 3%. Consider for a moment, oh gosh, where is, I want to look at the interest rate sensitives. So let's see here. That should be on the upside. Okay, so yep, Redfin, usually Open Doors up here as well. Yep, Open Door, Redfin, Enphase, Solar Edge, all your interest rate sensitive. Where's SoFi? SoFi is not moving as much, only about 43 basis points. Now, something I want to talk about because I think folks forget, TA matters. Technical analysis really matters. And I've been calling this breakout coming to Nvidia for a while. And I've been saying that when we break, if you want PPI summary, why don't you just scroll to the beginning of the video and play it back on 2x? You'd get it really fast. But yeah, once you get a breakout on 500, I really expected a movement on Nvidia. And I mean, quite frankly, we got about a 10% movement on Nvidia. So this should have been very, very obvious to folks. It was a Fibonacci retracement level, was 493. You had a psychological barrier at 500 for Nvidia. So there's a reason why you were having a lot of trouble breaking out of that region. And then you were actually just supported by your moving averages here in the middle, a benefit that Tesla did not see. Tesla did not get the moving average benefit at all. In fact, it barely stopped at the moving averages. So Tesla's responding much more to longer term trends and Fibonacci's than it is moving averages. Almost no movement there on the moving averages. So, okay, so let's for a brief moment go back to this doctor, supposed doctor. Again, I'm looking for bear arguments. One of several drivers behind higher financing costs. Okay, really? Now in terms of inflation, we're going to talk higher financing costs. Is mortgages. Monthly payment on a mortgage is up 91% compared to 21. Yeah, because interest rates like tripled, bro. Like, no shit. Like, this has nothing to do with inflation. This is like a symptom of inflation. TLDR. Inflation has made America demonstrably poor by thousands of dollars, but the Fed has now created as much money as politically feasible because it's an election year. Yeah, it might be true too. That might be a shot in the arm for the economy, but it sets up another ride on the roller coaster, inflation roller coaster. Well, no, it does not. It does not necessarily set up another ride on the inflationary roller coaster. Is this a comparison to the 70s? It probably is. You are here with Powell and Co. bowing to their political masters and readying rate cuts. I mean, honestly, just when you write stuff like this, you're super biased. Yeah. And then, of course, there's zero hedging here in terms of, hey, we're putting up a chart here of 1972 to 1983, but let's just totally ignore the fact that we left the gold standard. Inflation expectations were highly de-anchored. We just came out of price caps. We had an oil crisis, which to some extent we have a little bit of an oil crisis now too. But you know, this time is different. This time is like opposite in many regards. And again, I'm not saying that inflation can't resurge. It certainly can, but there are highly opposite factors of what we had. We had a Federal Reserve that was incompetent, and I'm not saying they're highly competent today. I'm just saying they were literally incompetent back in the mid 70s. They were a political pawn that nobody trusted, and so of course inflation expectations were de-anchored. People didn't actually expect inflation to come down until about 1985. That's how long it took inflation expectations to come down. Our inflation expectations today, let me see how far back I can go, but I believe they are roughly, oh, hold on a sec. This could be interesting. Hi, Katie. Oh, okay. Sorry. I thought this was Katie based on the, I saved her number last time. How are you? Yes. Yes. That's great. Thank you so much. No problem. That's amazing. Thank you so much. You too. Bye. Sorry. Okay. Okay. So, ooh, look at Bitcoin dropping here. How interesting. Mm, I do think that, um, I do think that there's a high likelihood you have a movement of trading bets from crypto in the short term into just like, frankly, stocks that have just been beat to crap. I don't know, but there are plenty of stocks that have been beat up that I think are great opportunities. Let's look at look at Intel. Intel bobbing around here, not really respecting the fibbies at all. Okay, so does this doctor have anything else to say? No. Honestly, it's pretty disappointing. Um, it's like, to be a doctor and to write a thread that is so devoid of logic should make you not a doctor. Like, the only thing you're a doctor of is doctoring up a Twitter thread. Oh, all right. Enough of. See, I need like a real bear argument. So I'm gonna meet Peter Schiff and Harry Dent. I'm actually going to go to Puerto Rico to confront Harry Dent and Peter Schiff in person. I think that'll be really fun, and so we'll get their perspective, and we'll see if George Gammon and Ken McElroy have some interesting insights for us today. My jadedness has told me those kinds of titles mean nothing. You're probably right. You're probably right. Confront means friendly interview. What? I'll come over there and I'll confront you. Where do you live? I'm coming. Neely Tominga. She's a major consumer bear. Is she really? Okay, let's see what her tweets are. Neely. Is she on the Twitter world? Tomiga. Neely Tomiga. Consumer and econ nerd. Okay. All right, ready? So I've never, as far as I'm aware, looked at this person's profile before. I feel like this is like Kevin looking at like dating profiles, but instead it's like whether I align or don't with your tweets. All right, let's see what we have here. All right, some investor dashboard. That's cute. What's this? Consumer net charge-offs increased $109 million by higher credit losses. Okay, so I mean that's to be expected. We do have weakness. It is true. Like credit card weakness is strengthening. But that's mostly because the lower, which we've talked about before, the lower 50% is getting absolutely reamed. And I sympathize with that. Like it sucks. If you have to rely on credit cards or BNPLs right now, it sucks. What do you got here? In the first 9 months of 2023, the home builder spent a total of $813 million on warranty claims. This is $136 million or 20% increase compared to the claims during the same period of 2022. I wonder how much of that has to do with the fact that we have had like a crap load of inflation, right? And it takes a while for those labor costs to show up in warranty claims, because warranty services are like an insurance, right? So I agree with this. I haven't fact checked the data, but I don't think that's that much of a surprise. Two truths and a lie. Health insurance or car insurance up 20.3%, and health insurance down 27.1%. Two of these are lies. I need more coffee. Well, first of all, oh my God, I don't even have to keep scrolling, and I know exactly what she did. And this is the kind of stuff that just pisses me off. The Bureau of Labor I'm losing my data a little bit. Is our are we lagging? Because I want to respond to this, but I want to make sure the data connection's okay. Meet Kevin Tinder, new Verse Pro. As long as the data, the connection's okay, I'll keep going here. But I'm getting a little bit of a warning here, so I'm going to wait a sec. Connection's fine. Okay, all right. Thank you. All right. Knock on wood. Oh, that's glass. There we go. Okay. So what she did is she totally ignored the fact that the Bureau of Labor Statistics has a massive disclaimer at the bottom of this BLS PPI report that says, look, we are using a completely new formula to estimate inflation for health insurance. So there's going to be some period of time where the inflation numbers are funky for health insurance. Notice she doesn't mention that at all. Does not mention that at all. That is very, very clearly biased. But that's what's trendy on Twitter. It's very trendy on Twitter to leave out very important context. Weak demand. Demand for seasonal and discretionaries remains weak. Okay, well, look, I mean, like, I cover this too. Like, this is totally fair. I mean, let's just go to Nike over here on ehack.com, right? Remember our Nike warning? I've talked about that Nike warning so much, but Nike was a real warning. I wrote, this is the start of the consumer recession. This is absolutely correct. So that's fine. I'm okay with that. Yeah, mentions of weak demand remain elevated. Yeah, that's fine. What is this? How far in debt are the American consumers? A lot. This is my love language. Oh my God. I don't always track consumer behavior, but when I do, I prefer distilled data. Okay. Do people actually read this stuff? Pulling back on inventory purchasing at a time in which interest rate levels are higher on short-term loans means you need a higher certainty of purchase. Everything costs more. This is interesting. So I mean, this is not a chart of inventory. This is a chart of average interest rates paid. And duh, they're higher, especially by smaller buyers. I don't understand how you're conflating these two things. And this is exhausting. I can't look at this anymore. I mean, I'm going to try to find like a inventory might be signaling a slowdown in demand. Well, no shit. Inventory is slowing down. Like we know this. We know that most like I honestly don't know who is screaming the consumer is great. I think that's an easy thing to do is like that um, of course member live doesn't work. The knock on wood didn't work. Oh, there it is. Okay. All right. So what do we have here? Let's look at the minutes. Oh, Nvidia is basically flat. Nvidia is trying to pop up again. Product. Sorry. I'll see you in the next one. Bye.